Hello guys, today we're going to talk about the most important indicator, the moving average. In today's video I'm going to explain to you how to use moving averages during trend, and I'm going to give you some tips of what to do and what to be aware of when using moving averages. We already did a video about technical analysis, and we also did a video about trends, ranges and breakouts, so you should check these videos out if you're not familiar with these concepts. What makes a moving average so special is that very easy for you to understand when a trend is developing using moving averages. The whole point of the trend is that the price is going towards a specific direction, doing higher lows and higher highs. And when this happens, it means that the price is going away from the previous prices, which are plotted using the moving average. So you will see the price moving away from the moving average. I'm going to show you that in CTrader. We have a node USD chart here. In order to plot a moving average in CTrader, you go to the function key indicators and you select trend simple moving average. So if we plot a 100 period moving average here, let's see what we're seeing here. In places that we have no trend, you see that the moving average is very close to the price. So and the price oscillates above and below the moving average, like here and here. However, when a trend is developing, you see that the price is going away from the moving average, and there is distance between the price and the moving average. The reason why this happens is because the moving average represents where the price should be based on the previous prices, but because we have a trend and the price is moving towards a specific direction, it goes away from the price that it should be. Now we're going to talk about what periods do when plotting a moving average. Let's plot a fast moving average. Fast moving averages are between 5 and 20 periods. So let's plot a 10 period moving average. You see that this moving average is very close to the price. And what this short moving average does, it helps us smooth out the price. So we see the direction of the price. Let me make it a bit fatter for you to see. You can do that in CTrader, select a fatter line. Okay. What this does now, it helps me see where the price is going without taking into account all the spikes. You see this big spike? It's smoothed out by using the moving average. So a short period moving average will be close to the price. A medium-term moving average, which is between 20 and 100 periods, is going to be far away from the price. Maybe not 20, maybe 50 to 100. So let's plot a 50 period moving average with another color. Let's also make it fat. You see now that because it's more periods, so more candlesticks are taken into account. Yeah, parenthesis. When we say periods, we mean that how many candlesticks are going to be taken into account when calculating the indicators, the numbers of the moving average. So 50 period means that it takes 50 periods, 50 candlesticks in order to calculate this price. And then on the next one it takes the other 50 and the same goes. So if we select a 50 period moving average, it takes more data into account. That's why it's not as close to the price as the 20 period that we plotted before. From 50 periods and above, it's better for determining trends. Now, if we go to a long-term moving average, like this is from 100 to 200, the most popular one is a 200 moving average. You're going to see that this is purely for understanding trends. So you see the distance between the price and the moving average. In consolidation, however, when there is no trend, all these moving averages are going to be very close together. See here, in this spot, when we have no trend, the moving averages are together. But as a trend develops, these moving averages go far apart. Now we're going to talk about the different types of moving average indicators. There is no best type to use. It depends on what you want to do. You can choose the type that you will use. First type is a simple moving average. The simple moving average is just an average of the prices. And what's so special about the simple moving average, let's plot a 50 period simple moving average now, is that it takes all the prices equally into account. Simple. The next popular indicator, the most popular moving average I would say, is the exponential moving average. What the exponential moving average does, it uses a formula that the latest prices are given more weight when plotting this moving average. You're going to see that on the chart. So this is a 50-period exponential moving average, and you see that it's slightly different than the simple moving average because it stays closer to the price. It reacts faster to when the price is changing. The reason it reacts a bit faster when the price is changing is because it takes the latest price into account more than the previous prices. So this candlestick, the last one that's plotted, the previous one is taken more into account when plotting the indicator. The next moving average is the weighted moving average. The weighted moving average, the concept is the same as the exponential moving average, it just uses a different formula for weighting. In the exponential moving average, the weights go exponentially. This one uses another formula, and this one gives even more weight to the latest prices. So you see that the weighted one, the purple one, is even closer to the price than the other two and reacts even faster. Lastly, I'm going to talk about the triangular moving average. The triangular moving average is a double smooth moving average. It means that it's an average of the average. And this indicator is going to be far away from the price because that's what smoothing does. You see, let me give it another color. Triangular moving average, let's make it green. This one is away from the price because it's smoothed out. It's a moving average of the moving average. So these are the differences between all the types of moving averages. Depending on what you want to do, you should choose what moving average you want. If you want a moving average that reacts very fast to the price changes, you should be using the weighted or the exponential one. If you want a moving average that doesn't react as fast, you should be using the simple moving average. And if you want a moving average that reacts very slow and smooths out the price a lot, you should be using the triangular moving average. Now I'm going to talk to you about the most popular methods of using moving averages when trading. The first method that I'm going to talk about is trading the moving average crossover. This is by far the most popular method of using moving average. However, I need to give you some tips because moving average crossover is not as easy to trade as you will read on the internet. So let's go to CTrader and I'm going to show you what I mean. We have here a daily chart of EUR/USD. We also have an uptrend here. So when trading the moving average crossover, what you're supposed to do is you have two moving averages plotted, a slow moving average and a fast moving average. In this case, as you can see, the slow moving average is 100 periods. It's a blue one. Let's make it fatter. And the fast moving average is 50 periods. Let's make this also fatter. What we're doing when trading the moving average crossover is that when the slow moving average crosses when the fast moving average crosses the slow moving average from the bottom up, we enter long. And when the fast moving average crosses the slow moving average from the top to below, we enter short. The whole point is that the fast moving average is closer to the price and represents the latest prices. However, the slow moving average represents the prices that go far into the past. So when the faster prices move higher than the slower prices, this is a signal to go long. And the opposite side is a signal to go short. That's what the crossover represents. So the logic of the moving average crossover is simple. However, it's not as simple to trade as I said before. The thing is that if you take all the signals of the moving average crossover, first it enters you in a very bad spot. Let's say this long signal, however. You're not going to buy it here, you're going to buy here because here is where the price is. So you're buying at a quite bad level. And also you're losing when there is no trend, definitely. So you're taking all these signals. So for example, you're taking this signal, it loses, then you take this signal, it loses again, and this again. So trading it is not as easy as it seems. That's the reason why I'm going to give you some tips when trading the moving average crossover. The first and most important tip I want to give you is you need to trade the moving average crossover when a trend has begun, or at least you have an indication that the trend will begin. In order to find this confirmation, you need to look into the price. You need to see that the price is doing a lower low and lower high if it's a downtrend, or higher low and higher high if it's an uptrend. So let's see that in CTrader. Let's take this for example. In this case, let's say that we're looking at the moving averages here. We see that the swing is going, it does a high, then it does a low. Okay, the lower is higher than the previous low, so there is a possibility that there's going to be a trend here. Then it does a high, but then the low is lower than the previous low, so we don't have the confirmation that we want, so we still shouldn't take any signal. However, next it does a higher high, and next it does a lower low. So from this case on, we can start trading the moving average crossover. It doesn't matter if the crossover is not crossing exactly. What matters is that we enter in a good spot and we have a trend to trade, like in this case. The next tip that I'm going to give you, like we said before, if you enter exactly on the cross, you're going to get a bad price. So you should be waiting for a retracement to the moving average before you enter. Let me show you that in CTrader. Let's say that you're happy with what you're seeing here. This is enough confirmation for you. You don't wait for this part. So on the next moving average crossover up, you're going to be trading. So in this spot. This spot, however, you see that the price is here. It's quite high. So it's better for you, instead of trading here, to wait for the price to go back to the moving average and then enter long. So instead of entering here, in this case you will enter somewhere here, which is a bit lower. This is not the perfect example because the price actually is close in this case, but if we look at this example, for example, if we see that to enter the cross here would mean that we enter here, which is very high, to enter long. However, if we wait for the price to retrace, we save 270 pips, so it's quite important. The next tip that I'm going to show you is when trading moving average crossovers, usually people enter on the cross and then exit on the opposite cross. However, this gives you a very bad price for exiting for the same reason that you get the bad price for entering. Moving averages lag a bit. I'm going to show you that in CTrader, and then I'm going to show you what you can do to get better exits when trading moving averages. So let's say here, for example, we take this trend. So we enter, let's zoom out a bit. So we enter here, and we want to exit on the moving average cross from the opposite side. You think that you're going to get all this because the price is crossing here, but you're not. You're going to exit here because this is where the cross happens. And if you enter with the cross, you'll also enter here because this is where the cross happens. So you see, from all this trend, you're getting just a very small part. It's better advice that I gave you already to enter on the retracement here so that you will get a bigger part. And also to, I'm going to give you advice on how to exit. So I'm going to show you some better exits instead of using this. One exit that is better than the moving average crossover is to make a trend line, and you exit when the trend line is broken. So here you see the trend line is broken, so you will exit your downtrend. This is a lot better than here, and you're winning. You're not going to lose 400 pips this way. Another way is to trade the trend multiple times instead of one time, and using a very close moving average, like an exponential moving average that is like 20 periods, or let's say 30 periods. And you enter every time that the price crosses the moving average on the opposite direction. So you can enter here, and you can exit here. Then you can enter again on the retracement, and you can exit here or here. The same thing you can do, let's make this now 50. The same thing you can do is with small trend lines. So I've shown you in another video about trend lines. You can draw small trend lines inside the trend and exit when these are broken. So let me color it in a better color for you to see. So you can exit in this spot, for example, then you can draw another trend line. Also you can enter on the retracement, and draw another trend line here, and you can exit here, which is a far better spot for you. Lastly, another exit is to use Bollinger Bands. You can plot like 100 period Bollinger Bands with 3 deviations. We haven't talked about Bollinger Bands yet, but this is just an example. And when the price touches the bands, you know that you are in high deviation, so you can exit. And the last exit that I'm going to show you is you can do a channel. So you have your channel here, you can go high, and you can be exiting when the price touches the channel. In this case, it's not so great, but it's another one of your exits. Another tip is, because sometimes it's kind of hard to understand if there is a trend, if you're trying to understand this only from using 2 moving averages, you can use more moving averages. Some traders use 3 moving averages. However, I'm going to show you another technique, which we call the ribbon moving average. Let me show you in CTrader. Let's go to this chart. You see this weird chart. Well, it's beautiful, and it's also not as weird as it seems. All these lines are different period moving averages. So the fastest one is a 30 period moving average, and we have increment of 15. So this one is a 31, this is 45, this is 60, this is 75, and it goes on up to around 200. You can do a different ribbon, you can do any ribbon you want. You can go increment by 1, you can increment by 10, you can start with 50 and end with 200 or whatever you want. The whole point is that because of the reason moving averages work, the moving averages are scrambled a lot when the price is not trending, with some strength. So you see in these places how close together the moving averages are, because the price consolidating and how much they're scrambling. And you see also that during a spike or a fast movement or a trend, they are far apart. So the ribbon makes it more clear for you if indeed there is a trend to trade or not. Now let's talk about the next way of using moving averages. We already mentioned it during this video, but I'm going to make it more clear. Moving average is a great dynamic support or resistance. So you don't even need a crossover. You can just plot one moving average and see the relation of the moving average to the price and trade it. I'm going to show you what I mean in CTrader. In the NZD USD 1 hour chart, we have a 150 period exponential moving average, and that's the only tool that we're using to trade. So when the price is above the moving average, it has a bullish tendency. So we believe that it's going up. When it's below the moving average, we try to trade it as a downtrend. We can also get our confirmation from the price, higher lows and higher highs than usual, and sometimes we don't need anything more than this to trade. In this case, for example, we can be the price is above the moving average, and we see that we have higher lows and higher highs. So from this point on, when we have our first higher low and higher high, we can start trading. And what we're doing is, because the moving average acts as dynamic support in this case, we can enter when the price touches the moving average, which is this spot or this spot or this spot, and exit using the rules I've shown you before. Same thing here, you see that the price is going down. When you find confirmation with lower lows and lower highs, you can also, like this confirmation, you can enter here and you can get a good profit. The next way you can use your moving average is using it as exit on your mean reverse strategies, or using it as exit during a trend. So let's go to CTrader, so I'm going to show you what I mean. In a mean reverse strategy, what we're doing is we're using an oscillator to enter the market. So let's see here in the USD Swiss franc chart. We have plotted an oscillator, and because we see that there is no trend and the market is just going in a range, and we're entering when it's overbought or oversold, and we're closing on the moving average. That's why it's called mean reverse. So we can enter here when it's overbought, and close here on the moving average. Again, enter long here, close here, enter short here, close here, etc. So that's the way we exit during a mean reverse strategy. However, you need to be careful to be using mean reverse strategies only when the market is ranging. And if the market is trending, you shouldn't go against the trend. When the market is trending, you can do what I've shown you before, which is plot a fast period moving average, like a 20 period moving average. And so, for example, in this spot, when we have a small trend, and exit when you have a confirmed candlestick plotted above the moving average. So you can enter here on the retracement, you can wait for the first candlestick, like this one is the first one that's completely above the moving average, and you get this profit. The next way we use moving averages is to determine how strong the trend is. You already got to that conclusion from this video already, but I'm going to show you exactly how it's done using moving average crossovers. So we go back to this chart. No, actually, I think I have it somewhere here. Yeah, there it is. So in this chart, what I have is I've plotted a 200 period moving average and a 100 period moving average. And I also plot an indicator called MACD, which means moving average, convergence, divergence. What this indicator does, you see, it shows exactly as a histogram the distance between those two moving averages. See, this is exactly when they cross, and the distance is plotted as a histogram here. The point of the MACD, one of the ways to use it, I'm going to tell you about that only today, is the higher the distance between the two moving averages, the stronger the trend. And also, when you see a trend being developed, but however, at some point the distance is getting smaller, that means that the trend is weakening. Like in this spot, you see the trend is weakening. Here's a better representation of what I want to show you. Look at this downtrend. You see it's going strong and strong, and at this point it's still going down, but it's a lot weaker. So you can understand that it's losing strength, and you can exit before you wait for the crossover or something else. In today's video, we talked about the moving average indicator. By now, I'm sure you understand how versatile a tool the moving average indicator is and how many different things you can do with it. It's no wonder that some traders who don't do technical analysis generally use only moving average and just trade with a moving average. Another important thing to consider is that on the daily chart, when two important moving averages cross over, like the 201 and the 51, this is news in some news agencies, and you will often read that in EURUSD the moving averages have crossed, or the price crossed above the 200 moving average. That's how important those indicators are. In the next episode, we're going to talk about the other trend indicators. We're probably going to talk about all of them, the remaining ones. If you like this video, don't forget to subscribe, and if you want, share it with your friends. Thanks for watching.